Howdy, Jacob here. Today we're looking at Avient Corporation in the chemicals industry. 4.1 billion market cap on 5.7 billion enterprise value. They operate as a formulator of material solutions globally. Okay, so growth is actually negative from 10 years ago and relatively flat over the last 9 years because there was a huge drop off here. I wonder if there was a sell off or something. 2015. Let's see. 2015, yeah, I see no devastation, so they must have just low on demand there. Gross margin, though, is up. Operating margin also up, so those are positive signs. Return on invested capital, however, is averaging mid-single digits, so nothing too impressive. Big increase in dividend, and it is currently greater than earnings per share, but on the last 5 years basis, it's pretty reasonable compared to their earnings, so their payout isn't too extreme. Balance sheet shows 500 million cash on hand with 10 million short-term debt, 2 billion long-term debt. So a lot of debt here, but that doesn't necessarily mean that you have to be concerned about it. For now, let's see what it is in relation to their free cash flow. So 2 billion in relation to their free cash flow, averaging about probably 200 million is 10 years. So it is a hefty amount. 2 billion is 10 years of their 5-year average free cash flow. So that means if their debt was due in 10 years and they did 100% of their free cash flow to debt reduction, then it would be able to get down to zero. So, I mean, not realistic. Companies are very common in refinancing that debt and getting new terms, new interest rates and such, but it does come to a concern because you can't just keep going into debt to fund projects. You need to be able to fund your projects organically through free cash flow. And we see here that long-term debt has over doubled from 10 years ago, so they're also funding it through debt, and it's gotten to a time where it's 10 times their 5-year average free cash flow. That is a lot of debt. You're going to have to bring that into your own assumptions when you're making your present value of earnings and free cash flow calculation on your end. For me personally, my initial analysis, I just like to think about it a little bit, maybe put it into my price earnings if to be based on enterprise value, but otherwise it's so I can look at companies sooner. But in saying that, let's just start making our assumptions. On the revenue growth side, I would just go with inflation, PE and price to free cash flow that's below average, and let's do a solid range here, or a little bit of a range here with share changes of 13 million in stock-based compensation. That's enough to just say whatever, let's keep it flat. And then the 13p, I'm just going to bring it down to 11 to be closer to be based off of enterprise value. And the dividend currently paying out 90 million is about 45% of their 5-year average free cash flow. They've increased that historically. I feel comfortable increasing that with their revenue growth, so it keeps relatively in line with that 40 to 50% payout ratio. And we still get to a price needs plus 62% given these assumptions. So again, please do your own analysis. Take into consideration the debt for you on margin of safety. And then otherwise, I think, it's an okay company, but these type of companies that aren't extraordinarily obvious from a earnings to free cash flow in the business, from a business perspective more so, if it's not the most obviously well-run, well-oiled machine of a business, then you definitely are going to want to be getting it really cheap because you don't have time necessarily on your side for the business to perform at a rate that kind of outdoes possibly buying at a slightly expensive, or what looks at a slightly expensive price. So anyways, I do hope you enjoy the video and have a great rest of your day. Thank you.